The topic for this video is how to maximize your returns, how to get the most out of every winning trade. And before we get moving, I'll add a note by saying that this is one of the most important elements for any trader and ultimately will help decide whether you're successful or not. Now, what you see here in front of you is a call out that I issued on Roblox for 135 calls that we entered at $2.34 and hit $6.10, yielding a maximum profit of 261%. Now, this was a trade that I found using unusual whales, and you can see some of the imagery below. If you'd like to learn a little bit more about how to identify trades, please see some of my other videos for unusual whales tips and methods. We're not going to cover that specifically in this video, since the objective is to help you understand how to get the most out of your winners and how to get the highest yield. So let's get right into that. Now, what you see in front of you here is the graph of Roblox, and there's a few things to cover just to get started because we want to be thorough and I want you to understand the ins and outs. So first of all, we see the underlying stock. That means this is the Roblox stock. This is in our options contract. And I want to remind everybody that the options move as a result of the underlying, but they don't move perfectly in tandem, as you know. You can see gaps, there's IV, there's your delta. There's a lot of things to consider. So I'm not just going to show you the underlying Roblox chart. We're going to go to the options chart itself and see how that behaves. The other thing that I want to touch on before we get started is absolutely critical. And I want to note that, yes, we ran from 234 to 610 for 261%. Does that mean if you were a good trader, you should have had a 261% return? No. I became a professionally licensed trader over 15 years ago, right out of university, as I've mentioned before. I didn't get that kind of return, and I wouldn't expect that of myself looking at this graph, and I'm going to break it down for you. And I just want to put up a red flag, as I always do. If you have someone saying that this is the return they hit, let's take this trade for example, and they say that they got out at the peak would be right here, or even close, because the con artists and people who lie about it will usually pull back a little bit because they know it's hard to believe, and they'll say they averaged out around here, and you'll see them in the graph. Red flag, they're lying. Now, one of the other things that we think about when we look at scaling out, we look at a trade like this, it gets us thinking, if you scaled out at about 100%, or you closed your position, and then you see it ran to 261%, you're going to see a lot of people tweeting, particularly if you're on Twitter or if you're looking in the communities about how they hit 200% plus or 250%. As I said, it's a red flag. Keep one thing in mind. 99% of these people are absolutely lying. They're lying because they're setting up con jobs. They're lying because they want you to believe something. And of the 1% who possibly did, they're actually bad traders. You traded really poorly. If you pick this trade up and ran it, and I'm going to show you the options price, and you scaled out here or anywhere near here and you close your entire position and this is your average, you got lucky. That's the kind of person who holds on far too long and is ultimately also going to take far more really bad trades where they end up getting out here. So now, before we start looking at these examples of how you would exit the trade to take profits, it's important that you understand the different methods that professionals use to exit and understand why. As I say all the time, I don't want you to just listen to somebody and memorize what they do, since the likelihood is that they just memorized a few things that they're repeating, and when things go south, everybody thinks, what happened? If you memorize without understanding, you're going to get into trouble. But if you understand, that's going to allow you to apply properly, build confidence, and be more successful. So method one is a trailing stop. Well, this is my preferred method for smaller accounts or traders who have yet to become consistent in generating profits. A trailing stop is available on every platform that there is. It's a feature. You can look at it and you can use a trailing stop and enter it with your order. So essentially, you set a profit target. Let's say you buy a contract at $1 and your profit target is $1.20 for a 20% return on investment. That's a good target. Then the contract, let's say, runs up to $1.25 pretty quickly, and you're faced with a decision. You can either sell and take 25% on your trade. There's nothing wrong with that. Or you can risk all 25% by letting your trade run and seeing what happens, right? This is a horrible strategy. And anyone telling you otherwise goes into the red flag scammer category, who doesn't know what they're talking about. There is another option, and there are other ways to do this. Because remember, capital preservation is critical. And protecting your wins are your capital. So when you see that you're ahead in a trade, that's your money. Don't look at it as, well, I don't have it. You don't have it because you haven't sold. Don't devalue it just because it hasn't been deposited into your account yet. That's yours, and you want to protect it. So the other option is where you can use either a percentage-based trailing stop or a fixed amount trailing stop. So let's assume we set a trailing stop of 10%, right? What does that mean? It means that we're willing to risk 10 cents here, right? Because 120, we had a dollar contract. 120 means we're up 20%. So every 10 cents is 10%. We want to risk 10% of what we've made so far in order to let our trade run. So let's say we had that entry price of $1 on our contract, and it's up at $1.25 now. So we're up 25%. This trailing stop of 10 cents would mean that we're willing to let the price come down 10 cents, and if it does, we exit the trade. If it doesn't, we keep running. This way you're making a calculated decision, not a YOLO decision, not some decision that some fake guru said makes sense. In this way, you're protecting your profits, but you're also giving yourself an opportunity to take more. And both are important. I don't believe you should just protect your profits and sell, because you do want to get those times where you can have big winners, and that just increases your average. And we'll talk about that later. So in this case, as long as the price never pulls back 10 cents, you'll continue enjoying upside. So let's say that the price pushes up or never retraces more than 6 or 7 cents, and it runs up to 215. Then at 215, there's a pullback and we drop down to 205. Your position would have been closed out at 205, giving you a 105% return. Why? Because you set a 10-cent trailing stop that trailed your price until it pulled back 10 cents. And so long as it didn't, you weren't being closed out of your position. Once it did, you did. So you got to enjoy the upside while risking some of your capital, but making sure that you don't pull back and lose what you've already earned. Now, how big of a trailing stop you should set will depend on your risk tolerance, experience, and the size of your account. If you're a newer trader or someone who's yet to find consistent success, then I think that anywhere between 5 and 10% is completely fine. Remember, you want to protect your capital. You can't grow an account that doesn't exist because you got wiped out, and piling up the profits, big and small, is going to help you out. Method 2. Method 2 is sizing out. Sizing out is when you take profits off the table by selling some of your position, but not all of it, and you allow the remaining position to run with the goal of increasing your average ROI. Sounds confusing? All right, let's look at an example. So our example is if I have 8 contracts that I purchased for $1 and we run to $1.25, I may sell 2 of them to lock in my profits and let my other 6 run up. If we pull back hard enough, I'll sell those, but my average will move up because the 8 that I sold at a higher price. If we continue to run up, I might sell another 2 at $1.50, another 2 at $1.75, and the final 2 at $2. Now, I tend to lean on this more when I'm concerned with liquidity issues, simply because a larger position size is harder to liquidate, particularly when there's lower volume. So if I see that and I'm in a winning position and I don't like the volume, I will start to scale out early as opposed to setting a trailing stop or combining the two. For all intents and purposes, if you're not dealing with large contract sizes, this isn't as efficient a strategy for you, but it's something that I want you to learn because as your account grows, you're going to be able to mix strategies and do things differently. You can always take size off to make things easier for yourself. Have 4 contracts, you can sell 2 and let the other 2 run. Now, it's going to come down to the specific scenario that you're in, what you're seeing on price action, how confident you are, and there's a lot of moving pieces. So this is another one where I say, again, if you have somebody coming out and approaching you with these hard and fast rules, that means they read something online somewhere, thought when they explained it to you it would sound right, and it's probably just another fake guru trying to get you to follow them on social media or whatever the case is. You're going to have to evaluate this a little bit yourself. Because like I said, if there's low liquidity, it makes more sense. If there's very high liquidity, a trailing stop might make more sense. If it feels confusing to you and you're not as comfortable doing this and you recognize that there's more execution involved, you could just stick to the trailing stop, but it's good that you understand this. In method 3, pretty easy. You do both. And at any given time, I kind of am doing both when I start to use sizing out, because when I sell off a portion of my position size, it doesn't mean that I'm going to let the rest of it do anything it wants. It doesn't mean that I'm going to take a loss on the rest of it or let it come down to zero. I have a trailing stop. So in that example, if I have 8 contracts and I'm up 25% and I sell 4 of them, let's say I sell off half my position, that doesn't mean I'm willing to let the other 4 go negative on me or take me back down to break even. I might just be more aggressive with my trailing stop. Instead of saying, okay, well, I'd normally sell out at $1.15, maybe let it come down to $1.10. So again, you can mix and match both, but if you find it easier to simply set a trailing stop, as explained for method number 1, do that for now. Do what you're confident in, tune out the noise, don't worry about what other people are doing or what they're saying. As I said, usually when people are bragging about these amazing results that they have, they're usually lying. All right, so now we move on to looking at the 2 different charts. You're going to see on the screen here. On the left-hand side is the chart for our options contract, and on the right-hand side is the chart for our underlying stock of Roblox. I wanted to put both of them up so you can get a visual of how they move in parallel, but I also wanted to have the opportunity to look at some of the differences between the two and how that might impact your ability to exit. Now, for the time being, we're going to focus on the options chart. Okay, now before we look at price action, it's important to note that a good trader always has a general plan. So it's not just about taking profits, it's also about limiting your losses, because not every trade is going to yield profits. Now, we could talk about risk management in far more depth because it's quite a complex topic, but we can at least go over some principles and general ideas that you can adhere to. I personally like to see a newer trader or a smaller account set their stop loss at about 10%. That means if your position falls to minus 10%, you're automatically stopped out. You enter this at the beginning, that way you're not tempted to let it run. As you grow and you build successful habits with a bigger account size, that can be modified, and I'll discuss that in a future video that takes a deeper dive into risk management practices, which is something that every single trader should engage in. But I wanted to make a mention of it so that you're not completely fixated on thinking, okay, it's only going to be profits, I'm going to focus on how to take profits. Limiting your losses is extremely important, because if you have a devastating loss, that can erode your gains from all of your winning trades. Now, in terms of your profit target, again, that's going to be different for each individual, but you should be seeking at least a 20% ROI if you're risking 10. That doesn't mean you'll exit every trade at 20% profit. As we explained earlier, there are methods that we'll employ to allow ourselves to enjoy the upside. But you want to have a reasonable target at where you begin to implement those methods I explained, the trailing stop and the sizing out. Typically, if your stop loss is at 10%, you want to look for at least 20% profit. It has to be more because you want bigger upside when you win on a trade. And again, that changes as you grow and move through time, but these are just some easy principles to work with. Now, finally, I also like to see stop losses moved up from minus 10 or wherever you have them to break even, that's 0, once you're up about 15%. And again, there's flexibility, but the idea here is you don't want to have trades where you're ahead a significant amount, and 15% is significant. You don't want to have trades where you're ahead a significant amount that turn red on you. Don't let a strong green trade turn red on you. The net effect of doing this over time is devastating. I have also found that working with private clients and even speaking to people in public, that these tend to be the most psychologically devastating trades. And as we know, you're only as good as your mind allows you to be. And I can understand why it's psychologically devastating. It's one thing if a trade doesn't go your way and you lose. It's another thing if you take profit, but you don't take as much profit as you could. But it's far worse when you're ahead a good amount and then you actually end up losing. So I like to move my stop losses up to break even. And I think that's a good practice just to make sure that, hey, in the worst case scenario, you leave what you entered with. All right, so let's put this all into action and take a look at it on the Roblox trade that we called out here. So here's our entry point at 234, and let's see how our strategies would have worked. So you're thinking, well, I don't want to just set a profit target of 20% and then exit. Great. Well, let's see how this would work even in a conservative situation. All right. So we have a move. These are 1 minute candles. You see this first move, We move up, things go great, they go our way. Doesn't mean you exit, because 20%, 234 would have been an additional 23 cents. That's 257, right? So 257 would have been right here. That's your 20%. But guess what? If you're using even method 1, we haven't seen a 10-cent pullback yet, right? Okay, great. So here we go. We're in. We move up. We hit a peak. We're up at 390. And it does give us a pullback. We have a trailing stop, 390. Pull back down to 380. That's if you're using 10 cents. Now, if you're using 10%, it's going to be a little bit more, because 10% of 234 is 23.4. Let's see, 23 cents. Okay, what's 23 cents off of 390? That's going to bring us down to 367. What's 367? That's a 57% return instead of getting out exactly at 20%. That is what we call letting our winners run. Don't worry about all this and the fake gurus telling you how they timed it. I'm going to take a little bit of time here to expose how they're lying and how that's impossible, or they're just really bad traders who got lucky once. Typically, they're lying. So let's take a look. If you use the strategy in the method number 2 where you also scaled out, we would have been able to let it run a little bit more. So you might have taken a little bit of size off here after you see that 10% pullback, but then what do we have? Get a little bit of a pullback there. We sail up pretty quickly to this point, and now we're well over 100%. And I'm going to tell you guys right now, as I mentioned, I became a professional licensed trader and an option specialist, a derivative specialist in 2005. I've been around this game for a very long time. I've worked with some of the best professionals in the world. I got out around here, and I was pretty happy with that trade. That's a great trade. That's over 100%. But let me break down why somebody claiming otherwise and how you can start to spot some of these scammers, these con artists who want you to sign up and give them $10,000 for their courses that teach you what you find on Wikipedia. When you take a look at this position, we're at 525. We're up over 100%, right? We're up about 120%, give or take. Then we have a major pullback. We pull back all the way down to 387. 387, you know what that is percentage-wise? That means you were up over 120%, and you allowed your trade to come down and lost 50% of your gains, because this is actually about 65%. Anybody who was willing to do that and just rides it out and sees it eroding is making a horrible trade. So you're going to simultaneously let 50% drop on you when you're ahead over 100%. You're not scaling out anything. You're not using a trailing stop. I'm saying this is what they claim. And then you continue to let it run, and you simultaneously try to position yourself as some sort of expert. You're fake and a liar, and you probably didn't do that. And if you did, you're just a really bad trader who's going to lose their money. Because how do you know that this is the peak? And look at the other losses they would have to sustain. They would have to go from being a 588 and retrace all the way down to 430, right? So to get out anywhere around here, look at the losses that you would have to sustain along the way. Nobody's going to know to time it here. You just don't know. If you had that kind of insight and vision into the market, you could see into the future. You'd be a billionaire, and you wouldn't be on Twitter trying to harass people to get them to sign up for whatever program it is you're trying to sell them. I'm exploiting how these people lie to you so that you can look at it in the future, monitor a trade and see how the graph moved, and figure it out for yourself. Because it's one thing to hear it from me. It's another when you start to learn it for yourself, which is my goal, and then you can see it. You can make the better trades for yourself. You can increase the maximum profit that you're getting. And you can also start spotting the liars, because they also mess with your head. Because if you start thinking that you should have gotten out around here, you're going to be making big mistakes. And who's to say? How do you know that you should have held on? You maybe held on another 20 minutes. Remember, these are 1-minute candles. You'd be back down here, and you'd be panicking, thinking, "Oh no, I want it to retrace. I'm going to wait." And then you end up here, and then you can't believe that this is happening to you, and then you're here, and then you finally end up in a loss position, and you can't believe it, and maybe you cut your losses, or maybe you get out around break even, when you could have had a great return. If you put $1,000 in on this, where we were getting out around here, you're now up at 1,500. That's great. You're growing your account quickly. 1,570. If you get out here, you went from $1,000 to $2,200. That's fantastic. So tune out the noise. Nobody's sustaining these kind of losses. They don't see that coming. I wanted to take a moment just so that you can spot this, start to see how you would get out of the trade, and also identify when people are lying to you, because I think that's what messes with a lot of our heads, is thinking that the way we're supposed to get out of these trades is near the top. Well, maybe not at the top, but I should go for 200% or 250 or get near the top. No, if you got out here, be proud. You took 57%. You scaled out some of your position here at 120. Maybe your average ends up 70, 80%. Fantastic trade. You followed the rules. Well, I don't want to say rules. You followed your principles. You had a strategy in place. You exited with maximum profit. Remember, if you were just taking 20%, it would have been down here. Here's where you are with the most basic of method one. Here's where you are with the hybrid. This is around where I was. Nowhere near here. All right. I hope that was helpful. Remember, we found this trade using unusual whales. Unusual whales is fantastic for lining up trades. We've been so successful. Please follow my Twitter at Profits Taken. I give free daily callouts. I show you how I find these trades on unusual whales. If you want to get set up with unusual whales, first thing I suggest, don't go sign up, even though I do have the sign up link in my description and in my bio. Check out my other videos, see how to use unusual whales. Then you can get signed up. And of course, my link gives you a discount. So appreciate it if you use that. Please keep the requests coming, and we'll see you guys next time.